The last session, we talked about synergy and control, two items that are often used to augment the value of a company. In this session, I want to talk about three items that can reduce the value of equity in your company. The first is distress, the chance that your company might not make it. Since much of what we do in valuation is designed for going concerns, if there is a chance that your business might not make it, either because its operations break down or it has too much debt, you're going to overvalue the company. We talk about ways of adjusting for that. The second is liquidity. When you invest in an asset, it's nice to know you can get out anytime you want. But if your investment is illiquid, it's difficult to get out, you're going to have to reduce the value of what you pay for that asset. And third, if there is the potential that your share of ownership could be diluted because more shares could be issued in the future, you have to affect that in your value today. In this session, I hope to deal with all three of these negative ingredients. So we've talked about the mechanics of discounted cash flow valuation. We talked about how to estimate the value of the operating assets, how to get from the value of the operating assets to equity, add cash, cross holdings, subtract out debt, and also how to deal with synergy, control, special issues that might come up in acquisitions. In this session, I want to close the book on intrinsic valuation by looking at three final issues. The first is distress. What do we do about companies that might not make it? And we're not very good about this in traditional discounted cash flow valuation. The second is illiquidity. How do we bring into valuation the fact that some assets are more illiquid than others? And third, what about dilution? The value of equity is the value of all equity in the company. What's your share of it worth? What if there are options outstanding? So let's start with the first issue, which is distress. Let's step back. When you do discounted cash flow valuation, especially if you use the going concern assumption to get the terminal value, you are in effect assuming that your company will last forever, right? And we know that companies don't. They get into trouble. They shut down. What if your company is one of those companies where there is a potential, at least, that could happen in the near term, the next year, the next 2 years, the next 5 years? Why might that be? It might be a young company where the operations might not pan out, or it might be a company with a lot of debt, which is unable to make its debt payments. When you have distress, and that distress is imminent, I think that you're going to overvalue the company using conventional discounted cash flow models. Because in conventional discounted cash flow models, we're not that great about bringing in truncation risk into our valuation. What's truncation risk? Well, the risk we're very good about dealing with is uncertainty about the cash flows. Is the cash flow going to be 100 or 500? We can bring that into the discount rate. The risk I'm talking about here is that the risk that there might not be a cash flow in year 2 or 3 because your company's not going to be around. So let me illustrate this with a very simple example. This is a valuation I did in February of 2009 of a company called Las Vegas Sands. It's a casino company. A fairly large casino company, a fairly successful casino company for the prior part of that decade. In fact, between 2000 and 2007, this company grew fast, built lots of new casinos, but borrowed a substantial amount of money to build these casinos. And as long as times were good, that didn't get them into trouble. But after the 2008 banking crisis, the company found itself in trouble. In fact, by the time I did this valuation in February of 2009, there was talk that Las Vegas Sands might not make it. I shut those thoughts out and I did a conventional discounted cash flow valuation. What do I mean by that? When you value a troubled company with a discounted cash flow model, here's what you do. You assume that margins will improve over time, the debt ratios will go down over time, that your company, even though it's distressed today, will become a healthy company. You attach a big terminal value to the company, you discount it all back, and you come up with a value for the company. That's exactly what I did. And the value per share that I got reflects that assumption that Las Vegas Sands will eventually become a healthy company. Value that I get is about $8 per share. The stock was trading at $4.25. It's a bargain, right? You should go out and buy it. But here's the catch. This is my value for Las Vegas Sands, assuming it makes it as a healthy company, right? What am I worried about? That it might not make it. That's not reflected in this valuation. It's not reflecting the cash flows. It's not reflected sufficiently in the discount rate. I tried. I raised the cost of debt. I used a high cost of equity. I used a high debt ratio. But as you can see, the cost of capital is a blunt weapon. It's really not designed to deal with distress costs. So here's how I brought in the likelihood that Las Vegas Sands would not make it. I went to a different market. I went to the bond market. And here I got lucky. Las Vegas Sands had bonds outstanding, and I could look up the price on those bonds. I use the price on the bonds to back out the likelihood that the company would not make it. So how did you do that? Now, the way we normally price bonds is we take the promised coupons in the bonds and we discount those promised coupons back at a risk-adjusted discount rate. I did something slightly different. I took the expected coupons. You're saying, what's the expected coupon? Well, to get the promised coupon, the company's got to be around to make the payment, right? So I multiplied the promised coupon by the probability that the company would be around to make that coupon payment. Because I adjusted the coupon for the risk, I could discount those expected coupons back at the risk-free rate. So think about it. I know the price of the bond, I know the promised coupons, I know the risk-free rate. I solved for the likelihood that the company would not make it. And given the price of the bond, which was a tremendous discount on par value at the time that I did this valuation, the bond market was telling me there's a 77% chance that Las Vegas Sands will not make it. Now step back. There's a 23% chance that Las Vegas Sands will make it as a healthy company. The value per share that I get of $8.12 from the previous discounted cash flow valuation applies in that 23%. The remaining 77% of the time, here's what I get. The company is going to have trouble making its debt payments. My equity is going to be worth nothing. My expected value for the company is a weighted average of $8.12 with 23% as its weight and 0 with 77% as its weight. With distressed companies, this is an additional layer you might have to make. I do this primarily with companies at both ends of the life cycle. Really young, high-growth companies and really old companies with a lot of debt. In either case, I think traditional discounted cash flow valuation is going to give you too high a number. Second step in the process is I want to talk about illiquidity. You know what the cost of illiquidity is? It's the cost of buyer's remorse. What's the cost of buyer's remorse? I'm sure you've had this before. You're sitting in front of your computer, you decide to buy a stock. A second after you buy it, you say, I wish I hadn't done that. You turn around and sell it almost instantaneously. Is it going to cost you? Sure. But it's not going to cost you much, right? Especially if you're using an online brokerage house. You might pay $10 for each of the trades, so it costs you $20. Plus what's called the bid-ask spread. The price at which you bought and the price at which you sold are not going to be the same, even though the market price might not have changed. Now, if this company were a large market cap company, an IBM for instance, that's going to be trivial. It might be 10 cents on a $120 stock. But if this were a smaller, less traded NASDAQ stock, the spread could be 5%, 10%, 15% of the stock price. What I'm trying to say is illiquidity is a continuum. There are no truly liquid assets, but there are some assets that are more liquid than others. A large market cap, very liquid company is more liquid than a NASDAQ, small, lightly traded company. That lightly traded small NASDAQ company might be more liquid than a private business that is never traded. So the question of how much liquidity matters will vary depending on what you're trying to value. Now, there are two different theories on illiquidity. One is that you can reflect the illiquidity in your value. In other words, do your valuation the way you normally do it, and then at the end of the process, attach an illiquidity discount to the value. That's a more common way in which people deal with illiquidity. Here's a second. Instead of adjusting the value after the fact, you push up the discount rate for illiquid assets. And you're saying, how am I going to do this? Let me at least lay out the table on how we're going to do this. There's actually a third approach that I will not touch on, which is to treat illiquidity as an option. It's kind of a messy approach. So it's an approach that I think is beyond this session. But let's talk about adjusting the value for liquidity. A good friend of mine, Yaakov Amihud, who teaches in the finance department at NYU, wrote a very interesting paper about 25 years ago with a co-author of his. Basically argued that when you buy an asset, you've got to build into the value your expectation of the transactions costs you expect to face and other people will face from trading the asset. Let me take a very simple example. Let's assume your transactions costs are 2% of value, and you expect to trade once every year. When you value this asset, you got to take the present value of those transactions costs in perpetuity and net them out against value right now. So if you're going to have one trade every year, it's a 2% cost each time, that'll create an illiquidity discount of 20%. Now, if you trade only once every 3 years, that discount drops to 6.67%. And that raises a very interesting implication about illiquidity discounts. They should be larger for investors with short time horizons and long time horizons. They should be larger for assets with higher transactions costs, real assets, real estate for instance, than with assets with lower transactions costs. So essentially, it's at least a simple rubric for thinking about why liquidity discounts might be higher for some businesses than others, for some investments than others. You could also try to adjust the discount rate for liquidity. And here again, there are two ways you can do it. One is you can try to bring it into your required rate of return model. Remember we talked about expected return, we came up with a risk-free rate, and we used a beta to measure relative risk, and an equity risk premium to capture the risk of the average risk investment. You could add a second element to that expected return, where you have a liquidity premium and a measure of how illiquid or liquid your company is, a measure very much like a beta, but measuring exposure to liquidity risk. You could then adjust the expected return or cost of capital for companies which are less liquid and push them up. I've seen models that do this, at least in theory. It's tough to convert into practice. So what you more often see is the second approach, where you try to push up the discount rate based on past data. What do I mean by that? You look back over the last 15, 20, 25 years, and you look to see how much higher returns have been on illiquid investments versus liquid investments. Let's say they've been 2% higher. You add 2% on to your cost of capital, and you move on. It's not sophisticated, but it does get the job done. But either way, you're adjusting value down for more illiquid assets. Last issue, dilution. About 20 years ago, US companies started granting more and more of the compensation they gave management in the form of options. By itself, it's not a big issue, right? Options give managers the right to buy shares in your company at a fixed price. But here's where it becomes a problem. When those option grants go into the millions rather than the thousands, it's a drain on the value of your equity. So if you're a stockholder in a company and the company grants options, you might be okay with it, but remember, those options create an overhang on your value. They represent a drain on your value, and you have to factor that into your valuation. And here there are two separate issues you've got to deal with. One is options that the company's already granted in the past, and the second is options they might continue to grant into the future. So let's talk about options that have already been granted. How do you bring that into the value of equity per share? I'll start off by describing two approaches that analysts often use that I don't think are very good approaches but get used nevertheless. The first is to divide the overall value of equity, remember the value that you got from your valuation model, by the fully diluted number of shares. So here's what the analyst is doing. He's adjusting the number of shares for options outstanding, and if the company has lots of options outstanding, coming up with a lower value of equity per share. That's a diluted value per share approach. The problem with that approach is you're ignoring the fact that when these options get exercised, there is cash that's going to be coming into the company. The second approach is called the treasury stock approach. In this approach, what you do is you add the exercise proceeds you're going to get from those options to the value of equity that you got, and then divide by the fully diluted number of shares. A little better than the fully diluted approach, but it ignores the time premium on the options. So what's the right thing to do? Here's what I think you should do. Take those options, value them as options. Because as long as those options have life, they're long-term, they're on risky companies, they drain your value. Value them as options. Subtract that option value from your equity value that you estimated earlier. Then subtract by the actual number of shares outstanding. Don't play games with the number of shares. What you get will be a value of equity per share that reflects the outstanding options. It doesn't matter whether the options are in the money, out of the money, deep in the money, deep out of the money. The value of the option should take care of that. As for options in the future, treat them for what they are. They're compensation expenses, right? And what do we do with the rest of compensation expenses? We treat them as operating expenses and reduce our operating income. So if you have a company like Cisco that continues to grant options, estimate how much those will be as a percentage of revenues, subtract that from your revenues, and you'll have operating income. Incidentally, with the new accounting standards, that should already be happening. Because when companies grant options now, they are treated as expenses, so your existing expenses should already reflect that. So let's sum up. Last three loose ends in valuation. Think about distressed companies, or companies where there's a risk that your company will not make it. Try to bring that into value. That might require you to estimate a probability that your company will not make it and adjust your value for that probability. Second, deal with the fact that you have liquidity differences across assets. Illiquid assets should be worth less than more liquid assets. Find a way to bring illiquidity into your valuation, either as a discount on value or as an increase in your discount rate. And third, if your company is granting other claims on equity, options in particular, value those options before you value your share of the equity in the company. I know that there are complexities in each of those, but keep your eyes on the price. You want to value your share of the equity in a business, and that's ultimately what you care about.